Hello everyone, and welcome to another episode of the Daily Gwei Refuel, where I recap the latest news in the Ethereum ecosystem. I'm your host, Anthony Sassano, and today's the 10th of April 2024. Alright everyone, let's get into it. So sorry for missing yesterday's episode, everyone. Another rug fuel. I hope you enjoyed the meme that I actually put in the Daily Gwei Discord channel when I announced that I wasn't doing a refuel. Just something fun there to tide you over. But back today with a bunch of stuff to get through. So first off, we're starting off with some new ETF news, I guess, or like rumors slash news. But generally it's not positive, I guess, but I'm going to talk through exactly what it is. So there's two tweets here. The first one comes from Nate. Actually, both of them come from Nate here, where he tweeted out, several ETF issuers have met with the SEC with regards to the spot ETH ETF, but according to Barron's, which is a media website, and I quote, those discussions have largely been one-sided, without the agency giving companies critical feedback needed to finalize their products, end quote, and the May 23rd deadline is quickly approaching. Now, of course, we all know that the main reason the Bloomberg guys are bearish on the ETH ETFs is because there hasn't been this back and forth. And as I've discussed before, I don't believe there really needs to be much back and forth because of the fact that the ETH ETF is a copy paste of the BTC ETF, but at the same time, there has to be some back and forth, right? There has to be the paperwork done in time for these things to get approved on May 23rd. Now, Nate put out another tweet just today where he was quoting the VanEck CEO saying that they believe that the ETH ETF will probably be rejected in May. And the full quote is, and this comes from the VanEck CEO, where they say, we were the first to file as well for Ethereum in the US, and we and ARK Invest, Cathie Wood, are kind of the first in line for May, I guess, to probably be rejected. And then I think they continue, VanEck CEO continues and says, the way the legal process goes is the regulators will give you comments on your application, and that happened for weeks and weeks before the Bitcoin ETFs, and right now pins are dropping as far as Ethereum is concerned. And obviously using the pins are dropping to say that there's silence from the SEC on this. But as I just mentioned, I know that this is obviously the VanEck CEO, one of the issuers saying this, but as I just mentioned, like there doesn't seem to be any reason for there to be much back and forth here on this, but there is a deadline here. It's like mid to late April, I guess, is like the deadline here in terms of just getting the paperwork done in time. So overall, not bullish news, I guess, or not bullish approval news on this right now. It seems that as I've said before, the market and in general, people have fully priced in a May 23rd denial here, from like a sentiment perspective, but also from a price perspective. But at the same time, I think that either way, it's going to be very interesting to see what happens on May 23rd, right? Like as I've discussed before, an approval obviously is going to be super interesting because it'll be completely against the consensus take right now, and it will be completely against, I guess, like what everyone has been saying for a few weeks now, is that the ETFs are going to get denied based on the fact that there's not that back and forth with kind of the paperwork. There's not that back and forth between the issuers and the SEC, which would have implications for future ETFs, crypto and non-crypto, and how the SEC may be taking a different approach now to any ETF that looks even a little bit hyped up because they don't want to create a circus around it. They don't want to create noise around it. So that would be an interesting implication there. And then, of course, it'll be interesting to see what kind of flows ETH gets, because obviously Eric, one of the Bloomberg guys, has said that he believes ETH is small potatoes compared to BTC, and the flows won't be that large. So it'll be interesting to see if that is true or not. But then I think it's even more interesting to see what happens when the ETH ETFs get denied, because it's going to be, I guess, like what reason is the SEC going to deny these things? Because there, as I discussed before, the two main reasons that people think that the SEC are going to use is, one, they're going to say that ETH is a security, or they believe ETH is a security, or they're unsure of ETH's status as a security or commodity, and because of that, they are denying the ETH ETFs. Or two, they deny based on weak correlation between spot and futures. Either of those reasons, to me, scorched earth approach, very weak. They're going to get sued over it, so on and so forth. But I think that's the where we're at right now. People are convinced that they're going to get denied, and they're just waiting for the reason as to why they're going to get denied here. Like, what reason is the SEC going to use? Because that, again, has broad implications for all of crypto, basically. And it's broad implications for the SEC, I think broad implications for Gensler, and we're going to see lawsuits following that, of course. No matter what reason they use to deny the ETH ETFs, I think there's going to be lawsuits regardless of the reasoning given here, but it's going to be interesting to see how that shakes out. And unfortunately, there's still 6 weeks left of this circus, and all of this could change. Like, let's say in the next couple of weeks, we start seeing some actual back and forth between the SEC and the issue is, then all of this changes overnight, basically. And I think that people would immediately get bullish on the ETH ETFs being approved because, as I said, the main reason that they're bearish on it is because there hasn't been this back and forth here. Even though there kind of has been, I mean, it's kind of funny that the issuers are actually meeting with the SEC, and it's been one-sided. So what does that meeting actually look like? Do they just sit in the meeting and the SEC people just sit there and say nothing and just stare blankly at the walls or something? Like, I don't know what that actually means, because it wasn't coming from, I guess, like anything but this media article here, which was based on quote-unquote sources, right? We all know what that means. They're not going to reveal who their sources are here, but what does that meeting actually look like? Is the SEC just completely stonewalling? Like, their issuers are kind of talking to them saying, hey, what do you need from us to get this over the line? And the SEC is just staring back at them with a blank face. Like, I can't imagine that's actually what's happening, but I'd be very curious to know what is happening there, what the SEC is saying or what they're not saying, because they can't really, say things that they're not, supposed to say or not allowed to say, that it can't really give confidence when there isn't confidence. But at the same time, are they taking this very kind of brutal and stonewall approach because of the fact that they hated how the BTC ETF circus went, the fact that there was so much hype around it, so much media attention on it, and the fact that that you had the fake news from the Cointelegraph intern, and then you had the SEC's Twitter account getting hacked on January 9th, a day before the BTC ETFs were approved. Did that kind of like stir the pot too much? Did that wake up the hive too much and cause too much of a ruckus? And that's why they're being so stonewall about it. So maybe that's hopium. Some people will call that hopium, but I'm just trying to run through all of the different, I guess, like facets to this, because there are so many different things that go into this, because we're really just speculating on really nothing at the end of the day. We're speculating on little bits of information that we get here and there. We're speculating on what's happened in the past. We're speculating on people's different opinions on these things. And then ultimately, we're speculating on what the market impact for ETH will be, whether it gets denied or approved. I actually think both things are going to be bullish for ETH. I think the denial has been priced in already. So by the time it actually does get denied, I don't think there's going to be anyone left to sell, really. But then an approval will be a surprise as well. People will be like, oh, okay, they actually got approved. And that will be bullish too, because no one was expecting that. So either way, I actually think it's going to be fine for ETH over, maybe not immediately. Obviously traders do their thing. If it gets denied, traders will be like, time to short ETH, right? Time to sell off ETH. But I don't think that's going to be a lasting thing at all. I really do think that, in general, kind of ETH, the denial has been, priced in at this point. And the last thing I'll say on this with regards to market impact, if you go back and look at what happens to BTC before it even got an ETF, it actually grew in market cap the same size as ETH's market cap. So its market cap went up by, hundreds of billions of dollars, basically the same size as ETH's current market cap. And that was not ETF flows. That was flows outside of the ETF. So anyone saying that, ETH can't go up without the ETF, I think that's completely wrong. ETH can very easily go up without the ETF. I mean, there are many, many different reasons people buy ETH and speculate on ETH and speculate on assets generally. I think it's wrong to say that ETH can't go up without the ETF flows. Yes, it'll probably have a harder time, especially going up against like Bitcoin, the ETH BTC ratio and things like that. That may be harder because of the fact that it can't compete with BTC flows. But at the same time, I don't think ETH needs an ETF to go to like that 15, 20K price that I've been saying this cycle. I think that it can go there just as easily with or without the ETF. The ETF is not just some magic money printer, guys. It's not some magic thing that's going to basically moon any asset that kind of has an ETF. What it does is create a really bullish narrative. And as you saw the narrative trade play out of BTC going from like 25K to, whatever it was, like 50K or something before the ETFs were approved, or maybe even higher than that, and you saw that kind of play out there. That was a doubling of BTC, at least. That was a doubling of its market cap, which I went back and looked, I think was around $400 billion worth of market cap, which is ETH's current market cap. ETH's current market cap is about $420 billion. So when you look at it like that, there's plenty of money out there. There's plenty of money that speculates on things for different reasons. So that's my general view on the market impact there. But another 10 minutes of a refuel talking about the ETFs. Hope it was insightful though, as usual. But as I said, we still have 6 weeks left of this circus, unfortunately, and I'll be covering it as best I can. I think it's just critically important to cover this stuff and to make sure people are educated on this. We'll see what happens over the next few weeks. All right, moving on to some Ethereum-specific news on the technical side of things. Vitalik shared this ETH research post that was put together by Tony here, analyzing what we're calling correlated attestation penalties, which is a recent proposal from Vitalik, which if you can scroll up to the top here, he proposed this about 2 weeks ago, where he titled this Supporting Decentralized Staking Through More Anti-Correlation Incentives. So you can go read this post for yourself. I think I may have highlighted it on the refuel at the time, but the gist of this post is to basically try and identify which validators are part of pools and which validators are part, are solo staking, which are smaller operations, so on and so forth. And the way that you would do this is by looking at the correlation kind of penalties between validators. So essentially, for example, if a validator was to miss an attestation, But then that validator is not alone. Like, let's say, maybe a better way of explaining this is, let's say, Coinbase's validators, they have 100,000 of them, or whatever it is, and then one of them or a bunch of them miss attestations at the same time. Well, you can correlate that. You can basically say, okay, well, these validators are all part of the same node operator set. They're all run by the same person, because typically the validators will be run on the same full node, or will be segmented into like certain chunks that will be run on the same full node, talking to the same full node and run on the same infrastructure. So essentially you have a way to correlate there. Whereas, for example, if my validators miss attestations, you can correlate that to me as a node operator, but like I don't have hundreds of thousands of validators, right? I mean, I wish I did, but I don't have that many validators. So you can basically say that, well, it looks like this person is more of a solo staker because they've got tens of validators, or maybe less than 10 validators, right? So they're a solo staker there. Whereas if you start seeing correlation between tens of thousands of validators, then you can be like, okay, well, this is a staking pool, right? This is a staking service. So the whole idea is to use this information to potentially improve Ethereum's decentralization of their validator set, and basically make it, less punishing for solo stakers to be correlated, and more punishing for pools to be correlated. So that's not, at least that's my understanding of how this works here. Now, as I said, Vitalik proposed this 2 weeks ago. It's just a proposal. It's not an EIP or anything like that. It's not a change that's going into the network anytime soon, from what I've seen. But yeah, you can go read that proposal there. But then the analysis that Tony did was basically putting some hard numbers on this. And he's got a bunch of nice diagrams and charts that you can look at in this post, which I'll link in the YouTube description below. And from my understanding, basically what he showed is that Vitalik's research was true. You can actually correlate, or you can actually basically study the data and see that when validators miss attestations, they tend to do it as part of a group. So if the validators are all part of the same group, then they'll miss those same attestations based on the same kind of like reasoning that the other ones missed the attestations. They all kind of correlate there. So you can go check out the data for yourself. I mean, I'm still ingesting this overall. There is back and forth on the thread about whether this is actually, data that's good enough to identify these things, whether we should be using this to inform decisions around, increasing penalties for pools or decreasing penalties for solo stakers, and so on and so forth. There's lots of information here to unpack. There's lots of back and forth to unpack. And obviously there's lots of different incentives at play as well, because at the end of the day, the incentive for, I guess, like bigger pools is to essentially cast doubt on this research and cast doubt on this generally, because for them, if we were to implement something like this, it would basically make their overhead larger. So they would have to, essentially, if they wanted to mitigate this, they would have to split up their staking operations into more segmented places. So for example, right now, if Coinbase is running all of their staking on one data center, or one kind of like, AWS or Google Cloud or whatever it is, they would have to change that and basically split that up into not just different cloud instances, but different kind of places altogether. So let's just say Coinbase was to run their validator, a bunch of them in the US, a bunch of them in Europe, a bunch of them somewhere else, so that there wouldn't be that correlation between them there. Now, obviously that's better for the decentralization of the network, and that tends to kind of, I guess, like dissuade pooling of assets into just like one place essentially. So overall better for decentralization, but at the same time, it does increase operator overhead. I mean, probably not by that much, to be honest, but it does generally increase the overhead here. And then you think about the implications that it has when Max EB goes live. Obviously, with Max EB going live, there's going to be a lot less validators on the network. So your correlation will be done based on less validators. So, it's based on the amount of ETH staked as well. Like, obviously, less validators, once you consolidate with Max EB, doesn't mean that the ETH stake is going to go down. Like, if you have, 32 ETH on 10 validators, so 32 ETH each on 10 validators, you have 320 ETH total staked, and then you consolidate that down to one validator, you still have 320 ETH staked. So it would be based on, I imagine, the staked ETH and not so much the validators, the correlation penalties themselves. But then it becomes the question of, okay, well, what is that going to look like? Are people going to essentially forego consolidating because they want to be able to split up their operation more? Are they going to use DVT to split that up as well? That's at least from my understanding. But this is a very fresh kind of research proposal 2 weeks ago by Vitalik, and this analysis was only done today. So yeah, that's my kind of, I guess, like I'll read on it. And Tony's conclusion in his post was that implementing anti-correlation penalties is a great way to counter economies of scale without requiring the protocol to differentiate between individual validators. While this analysis looked at staking operators and consensus layer clients, there are many more properties to analyze, such as hardware setup, execution layer clients, geographical location, ISP provider, etc. Finally, anti-correlation penalties are a great way to improve decentralization, and the Ethereum community should definitely consider it in future updates. I will talk to the first part of this where he said that it's basically a way to counter economies of scale. I think I didn't really directly mention that, but I mean, that's one of the big points here is that essentially staking pools have these economies of scale that they can take advantage of by basically centralizing all of their operations. And this is a way to force them to decentralize their operations, force them to not use economies of scale to their advantage, which is a pretty good way to, I guess, like mitigate that. It's a pretty good target to mitigate, but at the same time, I think the debate is around, whether this actually mitigates it or not. So we're going to be doing more analysis on this. There's going to be more data coming out, and there's going to be a lot of discussion around this. So I encourage getting involved in those discussions if you're interested. If you're a solo staker as well, it's definitely in your interest to do this. But great work here, both from obviously Vitalik, but also Tony for putting data to this. All right, so a big day for EigenLayer. So they have launched their mainnet just randomly. There's no announcement that it's coming soon or no announcement of a launch date. They've just launched it today. And with that came their flagship product, which is EigenDA. So you can actually go to app.eigenlayer.xyz, go to the AVS dashboard, and you can see that the currently live AVS is EigenDA. And you can click into that, and then you can see a bunch of stats around this. So you can see the amount of ETH that they've got staked against the EigenDA, the operators running the actual EigenDA, like they're all kind of listed here. Familiar names like Peer2 and I guess like All Nodes and Luga Nodes and Staked. You've seen these across other providers there. But yeah, I mean, the only AVS that's live today is EigenDA. You can go to operators, and you can see which operators are currently running on as part of EigenLayer, which are spun up to run with EigenLayer, and then you've got the usual kind of dashboard and the restake dashboard here to restake if you want to as part of the EigenLayer effort here. But the full information about everything is in this Twitter thread, which I'll link in the YouTube description below. I'm very excited to see EigenDA go live in particular, because I really want to see projects start utilizing EigenDA and see how scalable they can become. Because as you guys know, rollups use Ethereum L1 for DA. They're currently using blobs. They were using call data, but with EigenDA now, layer 2s as a general term get to use in my opinion, a very secure and very economically secure off-chain DA solution with EigenDA. Now, of course, if they're using off-chain DA, they are not a rollup. Like a rollup has a very strict definition that you have to use the same layer or the same settlement layer or the same root of trust for both your kind of proofs and your data, essentially. And I think that the layer 2 definition is a bit more loose about it. I know that some people disagree with me on this. I think even Vitalik doesn't refer to what we call validiums as layer 2s, but a validium is basically a construction that uses, it still uses Ethereum L1 for its proofs, for its bridging and all that, but it uses a off-chain or a non-Ethereum L1 data availability network. So there are many of these things. Obviously, Celestia went live recently. You have Avail going live soon. EigenDA went live today. You have data availability committees that are just made up of a bunch of permissioned kind of operators that aren't part of any project here. They're kind of like their own thing. But as I've discussed before, I truly believe that EigenDA is it's not the gold standard. Ethereum L1 DA is the gold standard, but EigenDA is the next best thing. I do believe that the fact that it has, similar node operators to what Ethereum has, it has ETH economic security behind it with restaked ETH. And at the end of the day, I think it's even more scalable than any of the other DA layers out there right now. I think that EigenDA is the golden choice after Ethereum L1 for your DA. Now, of course, EigenDA, because of the fact that it is purpose built to be a DA layer, and it is not like Ethereum L1. It is not as limited as Ethereum L1. It has more throughput. It's going to offer cheaper costs on the DA side for these, I guess, L2s. But in saying that, right now we aren't even at capacity for blobs, right? We were for a little bit because of blobscriptions or inscriptions on there, but right now we're not really at capacity on the DA side of things. But that can change very, very quickly. Obviously with some of these more, I guess, like inherently scalable L2s like Eclipse going live. They're using the SVM, which can do, I guess, like more TPS and are more scalable than the current crop of EVM L2s. There's Fluent, there's Move, there's a bunch of them kind of going live here. They're not going to, as far as I kind of know, going to use blobs from the get-go. They're going to use off-chain DA. And I think that they should be choosing EigenDA here. I think that is the best solution for them, or the best choice for them. And I'm very, very happy to see this all live here today, because it now gives those, I guess, builders the option. So as I said, there's a long thread here from the EigenLayer account on Twitter that discusses exactly what went live today. There's no slashing live yet, I believe. If you actually go, there's one tweet in particular where they say there's no slashing live. I'm trying to find the tweet here. Where is it? I should have had it up before. But yeah, there's no slashing live today, none of that sort of stuff. And I think the yields are definitely not going to be, oh yeah, here they say it. This mainnet launch does not include in-protocol payments from AVSs to operators and slashing. So we are allowing the EigenLayer marketplace to develop and stabilize before introducing in-protocol payments and slashing to mainnet later this year. So essentially, it's basically in beta right now. This is not like, it's on mainnet, but it's not like a full kind of product launch. There's no payments from AVSs to operators right now, and slashing isn't implemented at all. So it is that kind of soft mainnet launch that they're doing here in order to bootstrap this marketplace, in order to bootstrap the EigenLayer ecosystem, which I think is a fair play. But yeah, if you are interested in, I guess, becoming an operator, you can register with EigenLayer and opt into running AVSs. If you are part of a pool such as like EtherFi or Swell or whoever else, they will be doing that on your behalf. They'll be becoming operators of these of EigenLayer on your behalf there, so you can kind of get involved and see what those communities are doing there. But yeah, anyway, you can go read this for yourself. I'll link it in the YouTube description below for you to do so. All right, speaking of data, we have a nice little recap of EIP 4844 blobs 1 month on. Now, I did say to you guys that I'd love to see data coming as the months went on from when blobs went live, because of the fact that we're not going to get good data unless we wait a while. And so we have really great data here. So Liam, who is one of the core people as part of Optimism, put out a tweet with 4 charts. So you can see here that the median gas fees have lowered by 10 times, from 50 cents to 3 cents. Blobs are meeting L2 demand despite inscriptions. The Optimism Collective profit is at record highs, and L2's seeing all-time high record usage of 5 times in demand. Now, for anyone who's been following the Refuel and anyone's been following, a lot of people's tweets and casts on Farcaster there, this comes as no surprise to you. And anyone who's been using these networks, you feel the cheaper fees, right? So overall, cheaper fees, more scalability, more usage, and just a huge boon to the Ethereum ecosystem. And especially on the revenue side, which is something that people don't talk about a lot. These L2s are making a lot of revenue right now. Now, of course, that is because of the fact that we lowered the cost of data, and they're getting basically, I wouldn't call it like a rebate, but they're getting basically some kind of, it's maybe akin to like tax incentives of, when kind of governments give tax incentives to businesses to build within their kind of like country, or to build within a city, for example. And it's the same thing with Ethereum. We're basically given like these, I guess, like incentives to the L2s, to the rollups, to build and to scale up themselves, because they've given them cheap DA. So they don't have to worry about DA cost anymore. Now they have to worry about the execution layer side of things. So they scale up themselves, as we've seen, Base is doing, but Arbitrum's doing it as well with Stylus, and there's a bunch of other ones doing it too. So essentially, it acts as like an economic stimulus package for these L2s, which has been great to see. So I do expect those L2 revenues to level out over time. I do expect them to still be high, because the L2s are going to be capturing a lot of fee revenue from their users. But at the same time, the data costs are going to go up as well. They're not just going to be at rock bottom, because as demand goes up on the execution side, the data consumption goes up on the blob side, and then eventually you reach a point where blobs start kicking in the usual fee market, like they did when inscriptions was taking up a lot of blobs, and then we have to increase the blob capacity. So it is that, as I mentioned before, cat and mouse game of chasing data, chasing the execution scaling, and just basically ping-ponging off of that there. But you can go check out these charts for yourself. I'll link them in the YouTube description below for you to do so. All right, staying on the layer 2 topic, Jesse Pollack here tweeted out, or casted out on Farcaster, that there was a few minutes of 300 to 400 transactions per second on Base with no issues. Now, I do want to talk a little bit about this, because I think that when he says no issues here, he's maybe being a little bit generous, because there were a bunch of failed transactions in this. Now, of course, when you talk about failed transactions, it's different to, I think, how Solana handles failed transactions. It's not an apples to apples comparison here, but at the end of the day, like when you're talking about real TPS that has been landed on chain, I don't think it was 300 to 400. And also this is like extrapolating it out from a few minutes of activity, which probably isn't the best way to do this either. And this is again why TPS is a really, really shit measure of activity in my eyes. I don't think it's something that we should be targeting at all. I really think that overall, we should be targeting the other metrics. Maybe not TVL, because I also think TVL isn't great, but things like fee revenue for these L2s, which again isn't perfect, but it is a better metric, I believe, than TPS. Gas used as well, and beyond that, like the active addresses on the network too. I know that doesn't map one-to-one with users, but like active addresses is still, I think, better than TPS overall. I just don't think that TPS is the best metric out there, and I don't think that we can be kind of extrapolating, 300 to 400 TPS from just a few minutes of activity, and then when you actually look at the real underlying landed on-chain TPS, the actual process TPS, it's going to be lower than that, because I think it's a bit hypocritical of the Ethereum ecosystem to, I don't know, make fun of Solana or say, oh, look at all the failed transactions on Solana, and then the Solana people trying to do mental gymnastics and say, well, we have failed transactions because we've got so much demand, when in reality, it's just a lot of spam. I mean, you don't really, to me, it's not good demand. It's just like spam. Like, yes, okay, these are permissionless environments and anyone can do what they want on them, but that doesn't mean that us as humans have to value every little bit of activity the same way. We can have subjective values about it. And at the end of the day, I think we can all agree that pure spam that adds no value to the network is useless and should not be encouraged even on a permissionless network. And we should find ways of mitigating that or making it costly to spam the network. I mean, we've already done that on Ethereum since day one. We have priority fees, right? We have a way to meter that, where essentially, if you want to spam the network, go ahead. It's a permissionless environment, but hey, you're going to pay for that. You're going to pay dearly for that. So L1 deals with that with high fees, and it kind of dissuades that. But when you come to L2, they now have to deal with the similar things that Solana has to deal with, wherein that they have cheap fees, so they're prone to spam, or they're prone to failed transactions. So I don't think that we should be kind of a grave dancer or anything like that. As I've always said, L2s compete with these monolithic chains like Solana, like they are execution environments. L1 Ethereum does not. So L1 Ethereum doesn't have to worry about those issues of spam and failed transactions, because it's costly to do that. But in the same vein, as I said, like you can't be comparing Ethereum L1 to Solana, because Ethereum L1 is not an optimized execution environment. It's not trying to be super scalable. It does like 15 TPS. I know I said that TPS isn't the best measure here, but that's like capacity for Ethereum. I mean, I think if all of the transactions were ETH transfers, we could probably hit like 60 TPS, right? So yeah, I mean, when you look at it from that perspective, if you want to use TPS as a metric here, there is a very strong kind of argument to be made around the fact that there's real TPS versus fake TPS, or like I guess like non-on-chain or non-landed TPS and all that sorts of stuff. But yeah, I mean, the real issue at the end of the day is that when it doesn't cost much to spam, you're going to see spam, especially in an environment like a permissionless blockchain where there is financial incentive to spam. Because, for example, if you're trying to do MEV and then you're trying to beat all the other people trying to do MEV, and it's cheap for you to do that, you're just going to keep spamming the chain, which degrades the user experience for everyone. So I just think I wanted to make it clear that, even though Solana is having these issues, it's not exclusive to Solana. It's going to happen on the L2s. But again, this goes back to why I say that having an L1 be a monolith and having to deal with these issues and try to scale up execution while keeping fees low at layer 1, I've always believed for many years now that this is the wrong approach. This is the wrong way of doing things. And I believe it's not sustainable or scalable long term. And I think I've been vindicated on that. I think that is playing out, and sure, they're going to implement fixes. They're going to implement ways of making the network better. But at the end of the day, like, I think it's a fundamental thing where essentially it's not really based on technicals. It's more based on the economics behind it, the game theory behind it, and the fact that even when it comes into the technicals, there is a kind of ceiling here on this, or there is kind of like a limit to this. Whereas at the L2s, they do have to deal with this issue, but they deal with it in kind of like a contained way. L1 Ethereum doesn't have to deal with this. It has to deal with MEV, but it doesn't have to deal with the issue of spam, because we have a mitigation there with high fees. Yes, there's a trade-off here in that Ethereum L1 has high fees, but then the L2s all get to experiment on different ways of dealing with this sorts of stuff, all get to handle it in different ways. And then we have many L2s, so it's not just like if you're on one of these L2s, you're trapped there basically. If it becomes, if it becomes bogged down, or if it becomes, or if it comes out that, okay, well, they can't scale because of some fundamental flaw or something like that. There are other experiments playing out. And at the end of the day, in a properly constructed L2, you're always able to exit your funds on Mainnet. So from my understanding, even if you were to not be able to get your transactions through on the L2 itself because the sequencer is offline or getting spammed, you could still pay the fee on L1 Ethereum and do that. What is it called? There's a technical term for it. It's escape hatch. You can still escape back to L1 and get your funds out, even in the worst case scenario. So that's a really unique and a nice property of rollups here. But we'll have to see how this all plays out, guys. I think that anyone claiming to have scaled at this point is lying. L2s, L1s, doesn't matter. We haven't scaled yet. We are in the process of scaling. We are at the start of the journey here, and we're going to keep scaling from here. But all these grandiose promises of, hundreds of thousands, millions of TPS and all that, like, as I've said before, narrative is narrative, reality is reality. And the reality is that none of this stuff is scalable still right now. We're in the process of doing it. Ethereum is doing it one way. Other chains are doing it other ways. And we'll see which way wins out long term. I mean, I truly believe that the Ethereum rollup centric roadmap, the modular approach, is the winner and will continue to be the winner from here going forward. But it's a winner in relation to the monolithic approach. It is not the winner in relation to what scale we need to be at yet. We still need to scale from here thousands of times, guys. Like, there is still so much work to do, but I'm very confident that we're going to get there. So yeah, anyway, just wanted to have a little bit of a rant about that one there. And last thing I wanted to highlight was just this video here that was shared by Taiki, sorry if I've said your name wrong there, from this conference that took place in New York recently. So this is Nick Shalek basically giving a 7-minute spiel on what makes ETH and Ethereum valuable and what it enables for TradFi institutions and institutional investors generally. I think this is a really great clip. It's probably not news to any of us, but I think that you should be sharing this clip with anyone that may be on the fence about Ethereum or ETH and doesn't understand it. This is really great. So definitely go watch this video. If you haven't yet, just wanted to give a shout out there. I'll link it in the YouTube description below, but I think for today, that's going to be it. So thank you everyone for listening and watching. Be sure to subscribe to the channel if you haven't yet. Give it a thumbs up, subscribe to the newsletter, join the Discord channel, and I'll catch you all tomorrow. Thanks everyone.